I'm sure you've been watching these developments when it comes to the North Korea missile being fired over Japan for the first time since 2017. We saw a little bit of a muted reaction in the yen. And I'm rather curious that given the fundamental drivers of the dollar-yen trade at the moment, how strong is the haven impetus in a situation like this for the Japanese yen?
Sure. I think at the core of the dollar-yen long trade is obviously monetary policy divergence, and that has not changed. Of course, I think geopolitical risk events like this give some amount of safe haven bid, but what we have usually seen from markets, and I think we have seen it in Korea a number of times, is that markets usually get used to these missile launches, and then they do not have the same impact. So expect very limited, if any, safe haven bid for Japanese yen from this particular event. However, there are other things going on in markets which might make yen a safe haven again. There's definitely some signs of stress appearing in credit markets. If you follow the credit swap markets in particular, credit spreads have been widening. So I think those are, if those are the risks on your radar, I think yen still can act as a safe haven.
Where do you see the broader vulnerabilities when you take a look at emerging Asia in particular? Because they have seemed to be more resilient, but as you say, this dollar strength has really drawn down on those buffers.
Well, look, I think the fundamental backdrop for EM Asia has remained quite challenged for a while. But what we are seeing now is really the buffers which usually central banks rely on, which are FX reserves and rate differentials versus the US. Those have declined quite sharply. On the FX reserves front, I think central banks are really facing a triple whammy. First, obviously, there has been a lot of intervention in the region. So dollar has been used to support the local currencies. At the same time, valuations are also having an impact on reserves given the huge rise in the dollar and also in yields. And at the same time, if you look at imports, prices of imports have gone up quite significantly. So if you put all that together, what that has meant is that reserves in months of imports for Asia ex-China is now getting close to 7 months, and most central banks unofficially would prefer to keep it above 6 months. So there's not a lot of buffer that comes through from the FX reserves front. Similarly, on the rate differential side as well, if you look at Asia's rate differentials versus the US, 2-year nominal, that's at the lowest level since the global financial crisis. And I think that is also leading to some amount of dollarization in the region where residents and corporates are saying, why not just hold dollars? So I think usual buffers are running quite low, which really exposes some of the Asian currencies.
But that also tells you that we have seen authorities become very active, right? Whether it's direct intervention, whether it's just rhetoric as well. Does that also complicate the long dollar trade in a sense?
Absolutely, Shery. I think that's spot on because obviously official intervention has gone on for some time, but what we are seeing now is some of the more macro-prudential measures with an exchange rate dimension, those are getting introduced. For example, in Korea, we had the Bank of Korea swap line for their pension fund to take away some of that dollar demand. In India, there was a credit line announced for some of the oil refiners, again, to take away some of the dollar demand from spot markets. So those measures will certainly continue, and that does make things a little bit more complicated for the long dollar trade in Asia.
And Divya, we have also been following the latest on the UK, and we saw that jump in the British pound given the backtracking by the government of some of those tax cuts. But at the same time, traders seem to be betting that we will continue to see weakness on sterling. Where do you stand?
Well, last week we thought markets were getting perhaps too bearish, but this week it seems markets have swung in the other direction and perhaps markets are being too optimistic. Well, the rollback on the tax cut doesn't really change too much on the fiscal dynamics. I mean, we're still talking about a country, an economy which has current account deficit and fiscal deficit in excess of 7% of GDP. We're still looking at a central bank which has relatively limited reserves to defend the currency if needed. And at the same time, the central bank is hiking, but most likely into a recession. Our economists project next year's growth in the UK for the entire year at negative 0.1%. So it's obviously a very difficult macro backdrop for sterling. So we remain quite bearish. I mean, we're still looking at a move towards 105 on sterling by the end of the year.